What's up YouTube? Welcome to Wise Wealth, where we dive into all things personal finance. Today we're bringing you another one of our top 5 videos, and we'll be focusing on growth stocks. We haven't done one of these in a while, so I thought it'd be good to cover some of the top growth stocks available to us. Since we recently covered 5 of the top dividend stocks on the S&P 500, link in the top right hand corner or in the video description below to check that out, today I thought it would be good to cover 5 of the top growth stocks on the S&P 500 in 2020. These stocks focus on getting the most capital appreciation on your investment. We'll back up our examples with historical growth and why we think these stocks are destined to grow further. These firms won't be the best investments for passive income or dividend investing, with some of these examples not paying a dividend at all. But sometimes, if we can get significant growth on our investment, it may be wise putting some money towards growth stocks to build up the overall value of our portfolio. If you like this type of content, be sure to hit the like button to let me know. This is part of our top 5 series that we've introduced on the channel. If there are other top 5 ideas that you would like me to cover, be sure to let me know in the comments below. Subscribe to my channel for more videos like this, and make sure to enable the notifications by clicking on the bell icon. Without further ado, let's get into today's video. First on our list is Salesforce. Salesforce is a market-leading, cloud-based software company, specializing in customer relationship management software. This can range from communication management, opportunity pipelines, account information, and various levels of reporting. As of this video, they are currently trading at $171 per share. This software is essential to many businesses in normal times, but has become even more vital now more than ever. The analytical capabilities and reporting mechanisms that a dedicated software solution can bring to a business are highly desired, as they allow firms to make more informed, strategic decisions. With software such as Salesforce, firms can access levels of demand before and after the pandemic, customer activity, buying decisions, and much more. In addition to this, Salesforce cloud-based software allows them to deploy instances of the product remotely, meaning that they can take on new business, implement their products, and manage existing customer relationships entirely remotely. This should give investors confidence that the share value will continue to grow in the short to medium term, as well as the long term. Back in 2016, investors could purchase shares in Salesforce for just $58. This would have given a return of 2.95 times if held until today. That's a significant return in 4 years. In addition to this, a partnership between New York City and the software firm was announced to build the city's coronavirus contact tracing program, designed to track and test contacts of anyone who's tested positive for COVID-19. Maintaining business as usual while being at the forefront of the battle against the pandemic shows that Salesforce is not only a great company, but one that is prioritizing the battle against the pandemic over pure profitability. Number 2 on our list is Amazon. What started off as an online bookstore many years ago has turned into a multinational conglomerate with 750,000 employees worldwide. Amazon focuses on e-commerce, cloud computing, digital streaming, and artificial intelligence. As of this video, they are now trading at $2,409 per share. This might put investors off, but there are many trading platforms that allow investors to purchase fractional shares of companies if you want to invest less. In the past few years, Amazon has been at the forefront of consumer revolution. How we consume and interact with retail businesses has moved significantly to the e-commerce model that focuses around convenience. With the Amazon Prime offering that offers next day or even same day delivery on thousands of items online, Amazon swooped in and has established themselves as a market leader. What distinguishes Amazon from the competition is that it does not participate in the standard brick and mortar retail model, and instead focuses solely on e-commerce. In doing so, they have established an immense global network of logistics hubs and warehouses that allow them to operate at such a scale. The rise in popularity in this model has led to the founder of Amazon, Jeff Bezos, becoming the world's richest man, with an estimated net worth of $144 billion. Back in 2006, shares in Amazon could be purchased for as little as $26 per share. If held until today, those shares would have risen over 92 times in value. To put that into perspective, a $1,000 investment then would now be worth a whopping $92,000. Now that's not to say the trend will continue in the future, but it does show the power of the right growth stock at the right time, and also demonstrates that Amazon has the capability to provide immense returns to its investors. As such a significant growth stock, Amazon does not provide a dividend to investors, and instead reinvests profits into stimulating further growth year on year. Number 3 on our list is Tesla. Tesla is an American electric vehicle and clean energy company based in California. As of this video, they are currently trading at $799 per share. The firm is well known for pioneering the electric vehicle space, with its Model S car rapidly growing in popularity. Tesla is a unique car manufacturer in the sense that it hasn't been doing it for that long. The manufacturing of the cars takes on a much more technology-focused philosophy than the generic car manufacturers. In an interview, Elon Musk, founder of Tesla, said that their cars are not really cars, they are just giant computers. With that in mind, Tesla have established themselves as one of the leading manufacturers of electric vehicles and continue to innovate in the space above their competitors. Household names such as Audi, Mercedes-Benz, BMW and Porsche have all forayed into the electric vehicle space and have produced mixed results. While the interior and driver experience of these cars may be synonymous with the luxury brands and provide their passengers with the highest levels of comfort on the market, the efficiency of their cars have not hit the standards of the Tesla cars. Battery efficiency on the Teslas are unrivaled so far, and their acceleration is as fast, if not faster, than most supercars on the market. Tesla's share growth has been monumental as of late. With share prices of $179 in 2019, the firm has provided nearly a 4.5 times return on invested capital in under 12 months. This astronomical increase in such a short space of time grabbed the attention of Elon Musk a few weeks ago, where he took to Twitter to say that Tesla's share price was too high. This caused the stock price to tumble 10% on the day. So the risk of the renegade, outspoken CEO exists with Tesla that's definitely less apparent in the other firms on this list. Maybe something to think about. Like Amazon, Tesla does not offer a dividend. On Tesla's investor relations page, Tesla have announced that they intend on retaining all future earnings to finance future growth and therefore do not anticipate paying any cash dividends in the foreseeable future. So if it's passive income you're looking for, then this probably isn't the stock for you, but a great growth stock choice if historical values are to be trusted. Number 4 on our list is Nvidia. If you're watching this on a computer, there's a high chance you're using an Nvidia product right now. Another tech firm on this list, they're known for designing graphics processing units, commonly known as GPUs. As of this video, they are currently trading at $339 per share. Nvidia is the market leader in the GPU space, with only one real competitor that is also, in fact, a constituent of the S&P 500, called AMD. They're an honourable mention on this list as another great growth stock to look at, but I didn't want to include two firms that do the exact same thing, so check them out as well. But back to Nvidia. Their share price has grown significantly over the last few years. If we take their share value of $26 per share in early 2016, investing in the firm back then would yield a 13 times return on capital invested today. That's an extraordinary amount over a 4-year time period. Imagine an investment of $1,000 turning into $13,000 in 4 years. On top of this, the current dividend yield is 0.2%. While it's probably one of the lowest yields on the S&P 500, the added income you receive shouldn't be ignored, especially when your capital invested has the potential to increase 13-fold. Finally, at number 5 on our list is Apple. Everyone knows Apple as the designer and developer and seller of their own brand, hardware, and unique iOS operating system. As of this video, they are currently trading at $307 per share. Apple is known as one of the big 5 tech firms listed on the S&P 500, along with Amazon, who we've seen already, Microsoft, Alphabet, and Facebook. Apple's innovation over the years has transformed the way we consume tech products. They reformed the smartphone industry, creating a unique and user-friendly operating system that has guaranteed significant market share in the long term. They have nurtured a sticky user base, consumers that use their products so much and have become so used to them that the possibility of switching away for a competitor simply isn't there. Ask yourself, how many people do you know who have an iPhone will simply continue to buy one again and again so long as they keep releasing new models? Because of this, I think Apple is a great investment. They continue to release products at a premium that consumers are willing and able to pay. This guarantees steady revenues, and couple this with ongoing innovation, and Apple's share value will continue to see significant growth. If you had invested in Apple back in the beginning of 2009, you could have purchased a share in the firm at $11.76. That's more than a 26 times return in 11 years. This goes to show the value of holding stock in great companies over the long term. As a tech firm, the dividend yield of 1.07% isn't the most attractive. But as we can see from the share value growth, we're not necessarily in this stock for the passive income, but more for what it can do to our investment in the long term. As far as growth stocks go, Apple is one of the best out there. If you want more info on how to spot these sorts of stocks before they grow massively to make some serious gains, check out my video on this. It explains the cycles that growth stocks go through, how we can harness them, and how to capitalize on this so that we land a huge growth stock before it soars. Click on the icon in the top right hand corner to head there. I'll also leave a link to that in the video description below. So there you have it. 5 top growth stock investments on the S&P 500 in 2020. Thanks for tuning in today. Just before we end the video today, I wanted to give a special thank you to all of my subscribers. Since we released the last video, we managed to hit 100 subs. I really appreciate you tuning in week after week to watch the content, so thanks again, and smash a like on the video for hitting 100 subs. Make sure to subscribe for more if you haven't already, and let me know in the comments below if you have investments in any of these companies, or if you think there are others to include on a list like this. I'd be interested to hear your thoughts on what these might be. Until next time, see ya.